Hello class, this is Jim Turner, your professor, and I'm bringing you video number 3 of our series of 3. And again, this covers a portion of the cheat sheet that we've been reviewing in class, which summarizes some of the things we've been learning with respect to financial statements. Today we're going to cover some of the major differences in selected transactions between how they're recorded in the private sector versus the public sector. In particular, we're going to cover 3 specific instances. Number 1, when you're borrowing money. Both the private sector and the public sector certainly borrow money. Secondly, when you're selling fixed assets. A fixed asset can be something like a building. And the third category is when you're buying capital goods. A capital good in the public sector, for example, could be a fire engine, anything that has a long life to it. So let's take a look at our first situation where you're borrowing money. In the private sector, if you borrow money, well, you suddenly have an increase in assets because your cash goes up. But you've got to pay that money back, so therefore your liabilities increase. So we're going to assume that these equal for purposes of what we're doing here today, in which case then your owner's equity would be unchanged. The assets and liabilities would both go up. Under the GASB 34 statements in the public sector, the exact same thing would occur. Your assets would go up, your liabilities would go up, and in this case your net position or net assets would remain the same. In the traditional public sector statements, your assets will go up, but your liabilities are unchanged. The reason the liabilities remain unchanged is because we're assuming that you're borrowing money that has to be paid off over a long-term basis. And remember, the public sector is focusing on short-term assets and short-term liabilities. So paying off this borrowing over the long term is not going to show up on your statement. Therefore, your fund balance increases. So this would be recorded as an other financing source. An other financing source is the accountant's way of telling you that a transaction occurred which impacted the fund balance, but didn't make the overall government any better off or worse off. So in this particular case, your assets go up and your fund balance goes up, but the government itself isn't better off because ultimately the borrowing will have to be repaid. The second transaction deals with selling fixed assets. In the private sector, if you sell a building, your assets will go up because you receive cash for it, but that building would have been shown on your financial statements. Therefore, the value of that building, which would have been under the property, plant, and equipment, PP&E, goes down. So your owner's equity is unchanged. And again, you're assuming that the value of the building equaled the amount you received in cash for that building. In the GASB 34 public sector statements, once again, we have the exact same situation. Cash goes up and your property, plant, and equipment goes down, so your net position or your net assets are the same. In the traditional public sector statements, when you sell a building, no doubt about it, you're going to receive cash, and that's going to increase your assets because cash is a short-term asset. But the PP&E was a long-term asset, and therefore it didn't show up on your statement because, again, the public sector is focusing on the short-term items. And since it didn't show up on the statement, the only impact is that assets increased, therefore your fund balance increases. Again, you would have an other financing source is where you would find this transaction listed. The third item deals with buying capital goods. In the private sector, if you buy a capital good, your cash is going to go down because you had to pay for it, but the value of the good in terms of a long-term asset will go up, so your property, plant, and equipment value goes up. Once again, the owner's equity is unchanged. The same situation in GASB 34, your net position, or in the old statements, the net assets would remain the same. But in the traditional public sector statement, absolutely your cash is going to go down. You had to pay for the capital good, but this capital good that you now have, because it's a long-term asset, is not going to show on your statement. So the property, plant, and equipment won't be on there, and therefore in this case your fund balance decreases, and this would be reflected as an other financing source in terms of where you would find it on the statements. In our series of videos, we covered 3 items. The first video talked about who makes the rules. It reviewed the measurement, focus, and basis of accounting, and it talked about when revenues and expenses and expenditures are recorded. The second cheat sheet video covered the various financial statements, as well as walked you through the accounting equation in the 4 different areas. And finally, this last video, video number 3, covered 3 specific transactions which take place all the time and how they're dealt with differently between the public sector and in particular between the traditional public sector financial statements. I hope the 3 videos help you understand this. Study hard and good luck.